Crypto orders are fundamental tools. They are instructions you give to a cryptocurrency exchange. These instructions tell the exchange what you want to do. You might want to buy a crypto asset, or you might want to sell one. Orders specify the conditions for these actions. Understanding them is very important for any trader. Why do these orders matter so much? They are the building blocks of your entire trading strategy. Without understanding order types, you are trading with less information. You might make mistakes. Good use of orders can make a big difference. It helps you navigate the crypto markets more effectively. Orders help you manage your risk. Cryptocurrencies can be volatile. Prices can change very quickly. Order types allow you to set limits. They can protect your capital from large losses. They can also help you secure profits. The crypto market operates 24/7. Different order types can act for you, executing trades at desired prices even when you are not online. A market order is the most basic type. It is an instruction to buy or sell immediately at the current best available price. When you place a market order, you are prioritizing speed of execution over a specific price point. This order type is very common, especially for beginners in the crypto space. It is straightforward to use. How does a market order work? The exchange looks for the best price right at that moment. For a buy order, it matches you with the lowest available sell offer. For a sell order, it matches you with the highest available buy offer. The trade usually happens very fast. This is good if you need to enter or exit a position quickly. However, there is a potential downside called slippage. Slippage happens when the price changes between placing the order and its execution. It is best for highly liquid assets like Bitcoin or Ethereum, where many buyers and sellers exist. A limit order gives you more control over the price of your trade. You specify the exact price at which you want to buy or sell. For a buy limit order, you set a maximum price you are willing to pay. For a sell limit order, you set a minimum price you are willing to accept. This is a key tool for strategic traders. How do limit orders function? Your order is placed on the order book. It waits there until the market price reaches your specified limit price. If the market price reaches your limit, your order will be executed. However, there is no guarantee that your order will fill. If the price never reaches your limit, your order will remain open, or it might expire. Imagine Bitcoin is currently trading at $70,000. You believe it might dip soon. You want to buy it cheaper. So, you place a limit buy order for one Bitcoin at $69,000. If the price of Bitcoin drops to $69,000 or lower, your order will likely execute. You bought at your desired price. Limit orders offer price control, but might not execute. A stop order is a crucial risk management tool. Its main purpose is to limit potential losses on an open position. If you buy a crypto asset, you hope its price will go up. But what if it goes down? A stop-loss order can help protect you. It automatically sells your asset if the price falls to a certain level. How does a stop-loss order work? You set a stop price. This price is below the current market price for a long position. If the market price drops and reaches your stop price, the stop order is triggered. It then becomes a market order to sell your asset at the best available price. Consider this real-world scenario. You purchase Cardano ADA at 45 cents. You want to limit your risk. You decide you are willing to lose no more than 10% on this trade. So, you set a stop-loss order at 40.5 cents. If the price of ADA falls to 40.5 cents, your stop order activates. It sells your ADA, preventing a larger loss if the price continues to drop. A trailing stop order is a more advanced tool. It is like a dynamic stop-loss order. It is designed to protect gains while still allowing your position to grow. If the market moves in your favor, the stop price adjusts automatically. It trails the market price by a specific distance you set. This is very useful in trending markets. How does a trailing stop function? You set a trailing distance. This can be a fixed dollar amount or a percentage below the market price. For a long position, if the price rises, the stop price also rises, maintaining the set distance. If the price falls, the stop price stays put. If the price drops enough to hit the stop, the order triggers, usually as a market order. The main benefit of a trailing stop is that it helps you lock in profits as the price moves favorably, while also providing downside protection. It can help remove emotion from selling decisions. You define your risk tolerance up front. These orders are particularly effective when a crypto asset is in a strong uptrend. We have explored several key order types: market orders for speed, limit orders for price control, stop-loss orders for protection, and trailing stop orders for dynamic defense. Each of these serves a distinct purpose. They are all valuable tools in your cryptocurrency trading toolkit. Understanding them is the first step towards more effective trading. It is important to remember there is no single best order type. The right choice depends on many factors. It depends on your specific trading strategy, current market conditions, and volatility. Your personal risk tolerance is also key. What works for one trader might not work for another. Always consider your goals. Mastering these order types is crucial. You need to understand how each one works, know their advantages, and be aware of their disadvantages. By understanding and utilizing these tools, you can make more informed decisions. You can better manage your risk and potentially improve your trading outcomes. Continuous learning is essential in the evolving world of crypto assets.